Okay, so now we know the ATR, so average true range, and we also know the moving averages. From these two, we can go to the Keltner channels. So this was a 21st period exponential moving average. Keltner channels are usually channels that are drawn around either simple or exponential moving averages. I'll make 21 here. That means that it will be directly on the top of that one, like you see. So they are exactly the same ones. I'll remove that one. And for the Keltner channel, I'll simply change the colors a bit to whatever. The midline, I like to see it better. I can't see this blue, maybe my eyes, but white is much more visible. And the red is slightly, I don't know if I like that, so I'll make that, I don't know, teal. It's much easier for the eyes. So Keltner channels are average true ranges plotted around moving averages. And in this case here, I have plotted the second ATR, so the two average true ranges band on both sides of the 21 period exponential moving average. Let's see how that looks. Well, that's how it looks. Actually, I will add the ATR just to average true range. And that's fine. And I will add another Keltner channel. That one again 21 and 1. I think the ATR is 14. Well, that's 21 1. I'll change the color. No, what? It's simple, exponential. Now they're on the top of each other. I don't draw the middle line, and these bands, I'll make them some other color, say yellow and yellow. Another different yellow. Did I use that one maybe? Yeah, that looks more in harmony. So as the average true range is around 4.5. 62 plus 4.5 is okay, let's do minus. 62 minus 4.5 is somewhere there, 57.82. It may be that my periods are not exactly the same. This is 14 and that's 21, but the idea anyway is that the average true range, that's the first Keltner channel, so that's the average daily range of a bar up and down from the pretty much monthly average price. That is 2 daily movements out of the normal area. And when I drew the second here, you start seeing how it's kind of quite rare for the price to go outside of the second Keltner channel. Staying within the yellow lines is really normal. It's all this time it's between those, except that here it does something. It goes and kisses the second ATR and then makes its movements in between the first, like basically the normal daily range, or that's one daily range down and that's one daily range up. So that's already 2 ranges. And now it has picked a direction and it goes and touches the second one, takes a little pause and goes above the second one, pulls slightly back and goes above the second one after falling back to the -1. So I don't know if this makes sense to you or not. Why do you have only 6 months? Okay, Snapchat doesn't probably have. Let's take Microsoft. There's a lot more data and I want much more, let's say 5 years. 5 years of data for Microsoft. And here you see the same thing. Microsoft is moving quite nicely within the first Keltner channel around the monthly average price. And then something happens now and then where it goes to the second one and then it returns back to the normal. Here something crazier happened, so what if I draw the third one? Because I actually like to watch 1, 2 and 3. No, that's not weighted, I want exponential. And I don't want the middle line. So now there's the third one, and the lower band color, let's put it white, or that kind of color, quite close to white. And here again, there. So, like I mentioned in the average 2 range lesson, that I tend to take targets for trades from ATR, and that's what I do. I take targets for my trades from the Keltner channels, which contain the ATR, and now actually I failed in drawing that. That was supposed to be. This was supposed to be the third Keltner channel, not the second, because I had the second one already plotted. So now, there we go. There we go. So the normal range is here. And if I'm trading long Microsoft, if I would have, for example, taken a trade from here, I would want to take my profits away pretty much once it goes above the second one. Especially if it goes to the third one, because that starts to be really rare. Sometimes it does go to the third one and then it may do whatever after, but quite often after touching the third one especially, it is time to go back to the middle, even if the trend would then resume. So there it starts doing something. Third, back to the middle, back to the third, back to the middle, back to the second, grinding up to the third, and back to the middle, bounces up almost to the second one, and then falls down. Here it starts going again, bow, goes to the third one, falls, touches the third one again before falling back down. So basically a long trade from somewhere in the middle to the second or to the third one is where short-term trade profits should be taken, unless you want to risk a pullback and then wait, when are we going to go to the third one or even the second one the next time. Here it was in the middle, go to the second one, get your profits out once it goes to the second one, back to the middle. If you are trading it short, I don't know if you would be, maybe yes, maybe no, but if you did, here is maybe a good time to start thinking about taking some profits, because it went to the second one. It's quite rare that it spends a long time down there, and it didn't. Up to the second one, down to the middle, long time in the middle, goes to the second one and back to the middle. So the high probability target is somewhere in the second Keltner channel. There it went actually much higher, it went even to the third one and even higher before falling. Sometimes stocks do this, but for the high probability victories, the second and the third one are the reasonable levels to at least take some profits off it. There's nothing wrong in holding on to a part of your trade, of course, especially if you have longer dated options or if you're holding stock. But especially for options, the time decay for shorter term options, it doesn't usually take this kind of, okay, now we're going back down and after one more month we go higher. The cleverer thing to do is that when this goes up, just take the money off the table and wait for the next pullback to the middle. If you're still bullish Microsoft, here is a rather neutral area to buy it in the normal daily range. If you're bullish Microsoft, of course you believe that it will start going higher. If you had a reason to believe that this would go higher, here would have been a fantastic place to buy it. And then as it goes to the second one, start taking some profits. If you didn't take the full position, at least at the moment when it pierces the third one, now it's time to take the money off the table. Because most of the time it can't sustain that level for a long time. I'll check another example. Pinterest has been on a crazy run. So let's see what kind of trades we would have had. There it jumped above the third one. Taking profits on that day here would have been great, because from here onward it didn't move anywhere. It just waited until the moving average in the middle caught up with the price, and then it jumped up to the third one again, take profits, let it fall, let it go back above the midpoint, buy somewhere here, it goes up to the third one, take money, take the money off the markets, let it fall again, maybe buy again in the normal daily range, let it go to the third one, take the money, let it consolidate. Here it's again in between the normal daily range, buy some more, let it go to the third one, take your money off the table. If you didn't, well, of course, here was an amazing day, at least at that point. Take the position off, because what happens after? It drops and drops to go back to the neutral area, and then it starts moving higher again. So this becomes kind of the buy again here, sell somewhere here or here, wait for it to fall between. If you sold here, wait for it to fall between. Here it's pretty much in the neutral zone, can buy again, can sell again, can buy again, can sell again, can buy again from the midpoint, can sell again at the second level, buy again in the midpoint, sell again at the +2, buy again in the midpoint. Well, here you need to whether like take a pullback, or I don't know. Then if you sold the position here it's back to the neutral, maybe you want to buy again, third one, sell, back to the middle, didn't really go. Here it's back to the middle, but well, I'm long Pinterest, so it's back to the middle. I'm looking for it to continue higher, even though the DMI is actually negative now, but it's negative because of these huge moves downwards. Pinterest still looks quite good. So that's how we can combine the average true range and moving averages and already create a rather simple trading system out of these two. The thing is that we just need to find a stock that is going upwards and respects the monthly moving average. When we do find something like Pinterest, we can kind of already trade these shorter term movements on Pinterest. Right. I'll show you something where this, I don't know, I expect that this wouldn't have worked so great. Let's see. Here Dow Jones goes above, it pulls back, pulls back, pulls back. Now it's in the midpoint, so maybe buying here to the second one. Well, actually it could have worked too. The thing with Dow Jones is, actually there's no thing with Dow Jones. Would have worked with this too. Just it makes sense to watch the charts a bit. Is it normal for it to go to the -1 ATR? For Dow Jones it is. So maybe better than buying in the midpoint would be to buy at the -1 level and then try to play it higher to the +2. There's more movement to catch on Dow Jones from there. This would have been missed from that level. Here from -1 to +1. From, I don't know, that was already maybe looking a bit risky. But maybe from here to +2 again. I was expecting this not to work so well, but it actually worked quite fine. So here, especially from between the midpoints and -1 level, take a trade higher, sell. Another, take a trade higher, sell. Falling between here, maybe take a trade higher and sell. Now could be a nice time to buy it, except that the candles are so big and so red that I would maybe be a bit, I don't know. I haven't bought Dow Jones yet. There is a possibility that this keeps going lower, but when it goes to the -2, -3 level, that starts to tell me that maybe, who knows, it can be the time to buy, except if it becomes something like the COVID crash. Let's, for fun, check how did 2018 look for that. Well, that became a downtrend. So buying this candle that is outside on the negative outside of the third Keltner channel would have produced an alright trade, because there's a lot of distance in between these. there, that would have been a painful thing. Well, it didn't really fall so much anymore, just $5 for less than $5 down before it bounced up. And there, taking the profits at that level, it would have still produced from $8 profit just to the midpoint. Or from here to the yellow, to play it really conservative, $5 up. Not so bad. There, when it went finally to the third Keltner channel on the downside, buying somewhere here, giving it 1 or 2 months time, would have been a good trade already, like here or here. Seems to work also on indexes. I was thinking that it needs a crazy uptrend, but it doesn't need to be that way. But it makes sense to kind of watch how this is going, because for example Dow Jones, waiting for the -1 level seems to work better than buying in the midpoint. Whereas if we do that for Pinterest, which we checked first, well actually -1 level great trade. Yeah, it's not so. Yeah. Maybe waiting for a dip below here would also be giving better entries for Pinterest. Yeah. Fell below, buy and sell. Didn't fall below. Here finally fell below. Boom. Fell below, buy. There it goes. Fell between these two. Well, that was a crazier time, but it basically fell from the previous day's close down to that level when the market was closed, and then kept falling. So that was down more than $10 in one day. So that's 2 average daily moves down within just one night. I was thinking about buying Pinterest in here, but I was not brave enough to do it. It would have been a fantastic trade, but I didn't dare to do that. Anyway, I think this is becoming seriously long. But anyway, this is how to combine average true range and moving averages to create that kind of bands, and then pay attention how each stock moves in between those, and just know that it's quite rare to go above 2 for an extended period of time. Here it happened for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. So that's 3 weeks outside. No, the second one is here, so 1 day outside of the second one, and back down. 1 day outside, back down, then again outside, and then back down. So going above the T line is very rare. Above that level, it starts to be a good time to take risk off and wait for the pullback to add some risk.